All right, today we are cracking open the playbook that savvy investors are using to snap up commercial real estate even when the banks are basically saying no way. So if you've been looking at the market wondering how on earth deals are still getting done, well, you are in exactly the right place.
Look, if you're in the game right now, you've definitely asked yourself this question, probably more than once, right? It feels like the goalposts have just been ripped up and moved to a whole other field. Getting that traditional loan has become a massive headache, even for what look like really solid deals.
And that is the multi-million-dollar question we're tackling today. See, while a lot of people are just sitting on the sidelines, waiting for the market to magically get better, a small group of investors are out there closing deals. They're not waiting around. They're getting creative. So what's their secret?
Okay, so to really get their strategy, we've got to first understand the pressure cooker that is the current market. And this isn't just a vibe or feeling. No, the numbers paint a super clear picture of a major squeeze.
So let's just start with the sheer scale of what we're talking about. We've got almost $2 trillion in commercial real estate debt, a lot of it written at those crazy low interest rates we saw a few years back. And it's all coming due by 2029. This creates this enormous refinancing gap that, frankly, the traditional banking system just can't handle.
And, to make things even tougher, the banks that are lending have tightened their belts a lot. Right now, most will only go up to about 65% of a property's value. That means you, the buyer, have to bring a huge pile of cash to the table. We're talking a 35% down payment. For a lot of investors, that's just a non-starter.
But, and this is a big but, this is where things get really interesting. See, all these constraints have forced the smartest people in the room to get super creative. They've basically dusted off an old playbook and given it a 21st century upgrade. They're changing the rules of the game.
This quote just nails the mindset, doesn't it? The people who are winning right now, they are being proactive. They know that just sitting around and hoping for rate cuts is not a business plan. The real strategy is to combine or stack different financing methods to build what's called a capital stack. It's like layering different kinds of funding on top of each other to get a deal across the finish line today.
So here it is. This is the playbook. It's got 11 really powerful strategies inside. Now, don't worry, you don't need to memorize all of these, but think of them in a few groups. You've got your partnership plays like seller financing or a joint venture where you're working directly with the seller or other partners. Then you've got your treasure hunting plays like finding assumable debt, which is about digging up hidden opportunities. And then there are plays like using mezzanine debt, which is where you bring in different kinds of lenders to fill in the gaps. Each one is a tool in the toolbox, and the real magic happens when you start combining them. Now, we're not going to go through all 11, but I do want to zoom in on a few of the most powerful and, honestly, most versatile plays that are being used right now to get deals done.
First up, seller financing. But this is what we're calling version 3.0. It's a modern twist. The seller literally becomes your bank. So for you, the buyer, it means you can get financing without having to jump through all the hoops at a traditional bank. And for the seller, this is a huge win. They get to defer a big chunk of their capital gains taxes and create a nice steady income stream for themselves, often without having to deal with the day-to-day headaches of managing the property anymore. It's a classic win-win.
Okay, next up, the master lease option. And they call this one the zero down king for a reason. This strategy is a total game changer. It lets you control a valuable commercial property for a long time, think 7, 10 years, without actually owning it. And here's the kicker. You get to keep 100% of the profit from any rent increases or cost savings you create. That's massive upside with little to no money down. And why would a seller agree to this? Well, often they just want guaranteed, hands-off income without the hassle of being a landlord.
This one is such a hidden gem. There are literally billions of dollars in commercial loans still out there with these incredible fixed interest rates from a few years ago. I'm talking in the 3 to 4% range. If you can find a property owner with one of these loans, you can often just take it over or assume it. The only cash you might need is to bridge the gap between what's left on the loan and the final purchase price. It's like finding a needle in a haystack, but man, what a needle.
All right, so like I said before, the real pros, they don't just use one of these plays in isolation. No, they stack them. They combine them like Lego bricks to build the exact financing structure a particular deal needs. This is where we get into the advanced stuff.
Let's look at a real-world deal to see how this works. Check out how this industrial property was bought with only 5% cash out of the buyer's pocket. Look at this stack. First, they found an amazing assumable loan at 3.55% that covered 62% of the price. Great start. Then, they negotiated with the seller to carry a second mortgage for another 18%. Then, they brought in a mezzanine debt fund, which is a special kind of loan that bridges the gap, for another 15%.
When you add it all up, the buyer only had to bring a tiny 5% sliver of cash to close the deal. That is creative financing in action.
Okay, so you've seen the plays, you've seen how they can be stacked together, but the big question is, how do you know which combination is the right one for you and for what you're trying to accomplish? Let's break it down with a simple framework.
Think of this decision matrix as your cheat sheet. It connects your main goal directly to the right stack of strategies. So, for example, if your top priority is non-recourse financing, which means the lender can't come after your personal assets if things go wrong, then you'd look at combining preferred equity with mezz debt. Or, if you just need to close super fast, you might use what's called hard money, a short-term loan, and get the seller to carry a piece of the financing. The key takeaway here is to start with your end goal in mind, and then work backward to build the perfect stack.
Look, the market is definitely tough. There is absolutely no question about that. But it is not impossible. The real barrier to entry right now isn't a lack of capital, it's a lack of creativity. And now, you have the playbook. So the only question left is, what deal are you going to unlock?